Tiro? Hi, good afternoon, and thank you very much for coming. Today, we have been talking of several issues, all of them related with resilience and circular economy. And now we are dealing with something that is really very important, which is, of course, renewable energies. This is, of course, very much attached to climate change. But the most important thing is how to get enough financing for that. And I think that this is a very interesting panel because we will have good news and good expectation. And this is very important for this negotiation. I would like first to thank the Ministry of Ecological Transition for organizing this, Sarah, and of course Sarah Oppenheimer too for supporting us in the organization of this event. Now I would like to give the floor to the Secretary of State for Energy, Mr. Dominguez. Thank you.
Thank you so much. Good afternoon, everybody. Thank you for coming to this panel session that has been organized by the Ministerio para la Transición Ecológica of Spain, and in which we think we have a very crucial topic, and is financing renewables. How do we finance all this transition we have to make? And to discuss this, we have three great experts, three great panelists here. To my left, first is Mark Lewis. He's from BNP Paribas, and he's an expert on financing and financing renewables and things related to that. Then we have with us Nancy Sedge, who is part of the European Investment Bank. And as you know, the European Investment Bank is a key player in all the energy transition, in all the ecological transition that we must do in Europe. And third, and last but not least, as usually is said, we have Lena, that is she's a member of the Danish Parliament, Norwegian Department. I'm very sorry. Well, yeah, from the Norwegian. I'm coming from an event with the Danish embassy, and so Lena Vestergaard is member of the Norwegian Parliament, and as you know, the Norwegian Parliament has came out with great decisions regarding financing with a national fund, how to finance renewables and so on. So we have the perfect panel here. I don't know if you have the perfect coordinator of the whole thing, but I'll do my best. And well, we are in a situation, I think that is in all these events that we are having along these 2 weeks, it is obvious that we are in the middle of a transition, in the middle of a transformation, and that we must do this transformation. There is no other way. We countries that were committed to the Paris Agreement came with the conclusion that 1.5 degrees of increase in the temperature was the most we could stand without great problems. But after that, we have not been that good making our homework, and today we think that we have even more. We need even more effort that we thought we would need by 2015. But on the other hand, we are convinced more and more every day that we must do it, that otherwise we will leave this world to our children and to our grandchildren. We will leave a place in which they won't be able to live in a let's say, a comfortable way. So this is our great duty. This is what we have to do, and to do so, we have to. The three great pillars are efficiency, electrification, and renewables in electricity, because this is the path that we think is feasible. We think and we can see that we can do it by being much better in efficiency, by electrification of transport and some of the or many of the industrial processes and so on. And we have the technology to make renewable electricity, I would say, very cheap. Today, producing electricity with sun or wind in Spain, for instance, is half the cost that we have in the wholesale market of Spain today. So that's the way to go. That's the way to go. So we need now, I would say, two things. One, the money, the financing of this, and the second one is to convince the companies that exist today that the status quo must be modified, that we cannot keep investing in the same things in which we have been investing, and even more to have the expectation that we invest in oil and gas and that will last for the next 30 years and we'll be able to take away from the to have to use that money for new oil fields and things like that. Stranded assets is one of the things that are open in financing today. So, well, this is, I would say, this is the situation. So, coming to Lena Vestergaard, well, recently the Norwegian Parliament approved a new orientation for the National Investment Fund and how to transform this fund that used to have a lot of investment in oil and gas, how to transform that into a renewable energy fund. Could you explain us how this happened? What do you expect from the future? What are your plans in this investment fund?
Well, I think it's a lot about mindset, because in Norway we are 100% renewable because we have hydro, so clean energy has always been like a part of our, I don't know, soul, so to say. But we also produce oil, and lots of it, and we export it, and that's why we're a rich country. So that's kind of like the baseline for how Norway's built up. And we passed a law in Norway in June where the oil funds both divested more from coal, as well as that we decided to invest 20 billion in renewable energy. And it was basically, originally it was a political decision, but it's also financial, because for Norway, it's real, for us politicians, it's always important to make money. So for us, this is both a climate change decision, but also a means to make money. And I think that the government and parliament's idea is that we want the world's largest sovereign fund to invest both in solar, wind and other renewable infrastructure, both as a contribution to the green growth and making Europe cleaner and cutting emissions, as well as for us to stay rich, basically. And I think it's a sign of things to come. For Norway being such a huge country when it comes to oil, it's a really strong part of our identity. So this whole climate change thing is challenging for us, because we're on one side, we're very renewable, we invest a lot in renewable energy, we're proud of producing 100% hydro for our own electricity, but at the same time we make money on the rest of you guys buying fossil fuel from us. But I think the investment is a sign of things to come, and I also think that when it comes to the falling costs and the rapid technological growth, I think that up north it's probably going to give us high returns, and for us we see this as a really strong financial possibility for Norway. So for now we have decided to maintain somewhat in oil and gas for the oil funds, but we kind of have a double exposure because we make money off oil and we have invested a lot of money in oil. So when things change, and the Norwegian oil industry is very optimistic when it comes to for how long we're going to be in oil, but I think they're a little bit too optimistic, and I think the politicians are starting to realize this, and that's kind of pushing us more financially into renewable energy, because we're a little bit, or with good reason, starting to be a little bit afraid of stranded assets and this double exposure and putting all our eggs into one basket, which is a little bit scary for Norway. So I think that climate change at the moment is shaping the Norwegian economy and shaping a lot of decisions that we make. And I think that renewables probably are a lot bigger part of our financial future than it has been in the Norwegian history. I think that rather than to cling on to stranded fossil fuel assets, Norway has to use our wealth in a positive way and to kind of push us into a greener future and push Europe into a greener future. And I think it's, even if the Norwegian oil sector is a bit hesitant, I think the politicians are going to push it through. So we're going to see a lot greener Norwegian investment. And I think this part of the oil fund that we now invest in renewables, it's going to increase and it's going to become bigger. And at some point, it's probably going to kind of engulf the whole fund. So that's we're up for an interesting future, and I think it's interesting for the rest of Europe because there's a lot of money to kind of get from Norway. So,
yeah. Okay, we have some projects in Spain to talk to you. You know, that's I think is very good. It's very interesting that your parliament did such. Went ahead with this kind of initiative, and it's very good for the world in general. Okay, we also have with us Mark Lewis, as I was saying before. He comes from the private sector, so it's good that we have the vision of the private sector, how you see all the investments in renewables, the investments as compared to fossil fuels, oil and gas, what is how you see the market, how you see the investment market in the future, in the years to come.
Yeah. Well, I think, thank you, Jose, for the question, and thanks to the Spanish government for inviting me here on the panel today. I think I've been following the renewable energy sector. I'm an energy analyst by background. I've been following the utility sector, the power sector, for 25 years in Europe. And you've both mentioned now already stranded assets. We've already seen stranded assets happen in the European power sector. So I think what I'd like to do is just maybe spend 5 minutes talking about the lessons we've learned from the experience of the European power sector and what this means going forward, more importantly. Because I think when you look back to 2005, when at that time I was working actually for a German utility, and they were very reluctant to invest in renewable energy. And they said, well, why would we invest in renewable energy? We're very comfortable with what we know. Renewable energy is too expensive. It's never going to be competitive. If we invest in this now, it would be irresponsible to put our shareholders' money into this. And we don't even know if the grid can take all this renewable energy that the German government says it wants. Now, if you come forward 15 years, what have we learned from those criticisms that were made about renewable energy at the time? Number one, in Germany, I talk specifically about Germany, about 45% of electricity now comes from renewable energy. In 2005, that number was about 11%. It's gone much quicker than anybody thought possible. So we have to be imaginative because we keep on surprising ourselves. When we invest more money, we get economies of scale, we get better at doing things, the technology improves, things go faster than you can possibly imagine. So I think the first lesson is there is a very positive feedback loop between public policy and technology, the technology response you get. If you put incentives in place, the capital will come, you'll get economies of scale, you'll get technology improvements. That allows governments to put in place more ambitious targets, and the circle begins again. That's exactly what's happened. I think the cost reductions have been absolutely spectacular, beyond anything anybody thought possible in those days. I think actually it's one of the main reasons we got a deal in Paris where we did not get a deal in Copenhagen, because just in those 6 years between Copenhagen and Paris, the cost of solar came down from $400 a megawatt hour to about $120 a megawatt hour. So it made it easier for politicians, and I know we have two politicians on the panel here. It makes it so much easier for politicians to make the case when the economics are on your side. But for me, the most important lesson that we've learned, and I think this is the important one for the future, is that renewable energy is fundamentally different from fossil fuel energy, not just because it's cleaner and environmentally better, but there's a fundamental economic difference, which I think is not, even though it's a very simple difference, it's surprisingly difficult for people to get their heads around it, particularly the executives in the energy industry. So what do I mean by that? What I mean is, if you think about fossil fuel energy, whether we're talking about power production from fossil fuels or the oil and gas industry, the highest returns that you get are in the upstream part of the value chain. So if you think about a typical oil investment upstream, you'd be looking for returns there of 15 to 20%. Now, if you look at the renewable energy industry, you're very happy with returns of 6 to 8%. And the reason is, in oil and gas, you're taking a lot of risk. And investors demand a high return because you're taking a lot of risk. You've got to go out and find the energy. You've then got to produce it. And in conditions that are often very challenging, geologically challenging, environmentally challenging, and over time, over the last 120 years of the oil industry, you've had to go in search of harder and harder to find oil because the easy stuff runs out. And so the fossil fuel industry is inherently inflationary. Now compare that with the renewable energy industry. The first thing you notice is there is no upstream. There's no upstream. You don't have to look for energy. You don't have to produce energy. You simply have to build infrastructure to capture energy. And infrastructure is very low risk. You just have to build it. And guess what? When you build lots of it, it gets cheaper, because you get better at doing it, you get economies of scale, you get technology improvement. So the renewable energy industry is inherently deflationary. And our entire economic model, and for us as investors, this is a challenge as well, because our entire economic model for 250 years has been based on the idea of inflationary growth. And I don't think it's a coincidence that the Industrial Revolution, based on fossil fuels, and the discipline of economics were born at the same time. Adam Smith was writing about the invisible hand at the same time that James Watt was developing the steam engine. So I think there's a lot of interesting work to be done on that. We don't have time to go into that today. But my point is, we're in a fundamental shift economically, and renewable energy is the biggest opportunity we have to decarbonize the energy system, but it's also changing the way we understand the world in economic terms, and I think that is not appreciated. Now, to come back to my point, and I think this is the interesting question regarding stranded assets, is this. Oil companies, as I think utilities have learned the lesson, they've lost. The market capitalization of the utility sector in Europe today is 50% lower than it was 10 years ago, because renewable energy has brought down power prices in the wholesale power market, and it will continue to do so. As you said, Jose, new projects in Spain now, half the price of the wholesale, half the, so that's going to continue. Utilities have understood it finally, but it's been a painful lesson. They've had to make big rounds. The oil and gas industry, I think, is still struggling with this question, because they say to themselves, why would I invest in a renewables project and get 6 to 8% when I can invest upstream and get 15 to 20%? And my answer is, because in the future you won't be able to get 15 to 20%, because you now have a competitor that is cleaner and much cheaper, and will only get cheaper in the future. So I think we have to really, for our job in the finance industry now, and we are doing this, is to change the mindset about risk and return. Return is only one side of the equation. If there are high returns available, it's because there's a lot of risk that you have to bear. And I personally am much more comfortable getting a 6 to 8% return in a renewables project where I know there's going to be very low risk for 25 years than I am investing in an oil project where if that project runs for 20 years, you have no idea what the oil price will be. You may have seen yesterday Chevron took a $10 billion write-down on investments in the US shale industry. This is the problem with the commodity industry. Prices are very volatile. But I think the outlook for oil prices is downwards over the long term because renewable energy is going to conquer the world. And we all have to, policymakers, financiers, we all have to try and accelerate that move. And I think understanding these fundamental dynamics are crucial to that acceleration.
Yeah. Thank you for this interesting presentation of this very interesting point of view. I think it's very clarifying of how investors, I would say, must look at the new investments they have ahead of them. I think it's very important and it's very good to keep this in mind. Let's go to Nancy, who comes from the European Investment Bank. So we have here the point of view of the investors, but the public investors. A particular bank that also has made this transition in the strategy, in the way they see no investments in the energy sector. What can tell you us about all these things that you recently announced of changing your investment targets towards renewables and all that? It's very important for European countries.
So thank you very much for inviting me to come and represent the EIB. We are a global multilateral development bank, but we do, of course, most of our financing in the EU. And it's always a privilege to be in the pavilion of one of the shareholders. So thank you very much for inviting us. Normally, when we do these speeches, we talk a lot about how much we've lent to renewables or transport or whatever it is in the past. And in fact, the Vice President, who would have liked to have been here, signed only yesterday a renewables energy project in Spain, 26 million euro for a solar project, Solar Storm 200. But you asked me to talk about how we've changed what we're going to do in the future. So I will focus on that. We have taken a really big step forward this year, but it's built on something that's been coming a long time. So I think it's interesting what you said, Mark, about how, you know, this trend has been happening, but perhaps people have sort of started to wake up to it. In 2015, in the advance, ahead of Paris, the bank's board approved a climate strategy, which in fact was extremely far-reaching. It looked at things like assessing value at risk in the portfolio. It said we had to mainstream climate in everything we did. It said we should look at different standards and criteria in all of our sectors. And one of the things it said was that every sector lending policy, when revised, or new ones, must be underpinned by EU policy, and the "and" is very important, and follow a low greenhouse gas path, and be informed by the latest scientific knowledge and best practice. Well, I don't think anybody here at the COP is under any illusion that the latest scientific information is pretty serious, and we are talking about 1.5 degrees if we want to live in a world that we recognize, and that our children will live in a world that we would recognize. So this was the kickoff point for our energy team. And when we went into the public consultation, this was just completely reinforced, not just from NGOs, but from the public and from a lot of companies and banks as well. Of course, there were some different views. There always is. And there were different views in our board when it came to be discussed. It went to the board 3 times, but in the end, there was an overwhelming approval of 2 things. And this is what I want to say. I mean, one of them is, of course, the energy lending policy, and I'll give you a bit of the nitty-gritty. But the board also approved our new ambition in climate and environmental lending. And there's a couple of points in there I want to emphasize, because it's not just about what we finance more of, it's, as you said, what we finance less of. So the board also approved our climate ambition as the EU's climate bank, that we will align all our financing activities by the end of next year with the goals and objectives of the Paris Agreement. This is actually a massive task, but we will do it by building on the climate strategy, which already said in 2015 that we must follow latest scientific information. And of course, the energy lending policy is the first and biggest block of that. We will now, and in fact our sector experts are already working on transport, industry, water, agriculture, thinking about what does this mean for their sectors, for us as the EIB to align all our financing activities. So this is how we got to the energy lending policy, and it does bring in a couple of very important things. One is that, as you said, we have to do more renewables, more energy efficiency. We have to also do more electrification, and we also have to do more storage, in fact, storage of power. So that is all in there. And indeed, this big focus on energy efficiency first and much more renewables is a critical part. But it also introduced a much more stringent emissions performance standard. So I'm going to go a bit techie for a minute, so excuse me that I'm the climate change expert of the bank. It was 550 grams per kilowatt hour in 2013, and already from then it effectively excluded coal and diesel power. Now it is 250 grams per kilowatt hour. That excludes, for any new projects, any fossil fuel power generation project that doesn't abate the greenhouse gas in some way. I mean, if a project comes forward with operational carbon capture and storage, and that project can come below the 250, it's still eligible. But the door is shut on any new projects. You may have seen to 2021. This is for approvals of power generation projects that are already under formal appraisal. So if they're already under formal appraisal, they have until 2021 to be approved. But no new projects can come into the bank now that don't meet the 250. Now, what are you going to then do instead? I mean, our energy teams are not going to go, well, that's good, let's take a flexi. No, they're going to do a lot more renewable energy. And I want to highlight another very important part of this. We're talking here in an EU pavilion, the Spanish pavilion. Of course, this is very important in the EU. It's an important part of supporting Spain and other countries' national energy and climate plans. But it's also the same approach in our global development finance. And we do actually finance globally in developing countries all around the world, all sorts of sectors. And climate action is one of our priorities there. And we have taken the same approach, because SDG 7 says affordable and clean energy. It doesn't say affordable and dirty energy. It says affordable and clean energy. And developing countries want power. They don't want stranded assets. They don't want to be indebted with something that will have to be shut down in 10 years. So we feel that as the EU bank, we should be doing the same thing in developing countries. Now, obviously there you may need more off-grid solutions because you don't have perhaps the interconnectivity. But maybe that's also going to be part of the solution in Europe. That, as you said, it's a sea change in the thinking. We can have more renewable solutions near where the power is used, and that's what PV panels on the roof of our houses are. As you said, the sun is there, you put the panel there, it's on top of the house, voila. So, I mean, I think it is a big change, and we see no reason not to do this to drive the SDG agenda as well as the low carbon agenda. I want to highlight another thing that you said that we had agreed, which is that our board has approved that we will go to 50% climate action and environmental sustainability finance by 2025. This is a massive increase for us. And for those of you wondering why we use such a long term, all I will say is EU taxonomy, because that's why we say climate action and environmental sustainability. There's a thing in there I want to mention about the renewables, though. And so this is a kind of word of things that are coming. green finance is terribly important. But the day that you could label something green without considering what other impacts it was having has gone. The taxonomy, and the first report was published in June. Watch out for the final report. I believe the regulation is being voted today. You may know more than me, but anyway, the taxonomy report will come out from the technical expert group now at the end of February. But you will have seen already that it's about contributions which make, substantial contribution, which clearly for renewable energy is towards mitigation, and doing no significant harm to the resilience goal. So if you have renewable energy projects where nobody has done a climate risk and vulnerability assessment to see whether they can withstand higher wind, more snow, floods, it's no longer going to be possible to count those as sustainable finance. The same with biodiversity, depollution, circular economy, and water. Any green project cannot cause significant harm to one of these other objectives. And this is a real total change in the way we look at sustainable finance. We must not do a major contribution to solve one problem and create a whole load of other problems. So what I would say is, if you're in renewable energy, get out there and make sure that your supply chain, your clients, your finances have looked at whether they are resilient to the impacts. And of course, Spain, like many European countries, is already experiencing those impacts. The last thing I want to say, part of our energy lending policy, very, very important, is just transition. Because there are going to be people and regions who are dramatically impacted by this shift of finance. And all the policies in the world cannot fix everything. But we've seen very clearly that if we don't go along a socially inclusive route and address this and look it in the face, we are going to hold back this urgent, thing. And so I'm finding it funny. On one side we have ambition, on the other side we have inclusion. So the Spanish pavilion has it in a nutshell. And so we at the bank will be working closely with the European Commission on the Just Transition Initiative. And probably I'll stop there, but later on if there are questions I'll try to answer them.
Thank you very much for your words and all these these thoughts that are really important for all European countries. Let me go back to Lena. Sometimes when you go around, you go to international conferences, energy conferences, and so on, you see that the world is, at this moment, I would say, is somehow divided into groups. One is countries that have already identified that renewables is the only way to go. And normally those are countries that are net or big importers of energy. And the other group is those countries that are exporters of energy, and somehow they are forgetting about all these things. You talk to them and they have all their plans that they have, they will increase and so on. Norway is a country that is in both sides, I would say. You were mentioning before that you are 100% renewable in the electricity, but you are exporting oil and gas to other countries. So do you see any can we expect for countries that are big oil producers, big gas producers, and in different regions of the world, in particular Middle East, how you see Middle East, how you see the US, in the sense that with all the shale gas and shale oil that they are producing recently, and they put down all the gas prices and all of them. How you see the whole situation as of those countries that still are in the, let's say, old way of doing business here?
I think that's a really good question. I find it really interesting because we meet with lots of other oil countries, and they're organized very differently than Norway. I think Norway is a really idealistic country, and we're very, maybe even a little bit naive, but we're very down to earth, and we haven't been like, I don't know, very aggressive when it comes to oil. But at the same time, I think in Norway, it's a mix of being idealist and capitalist, because I don't think we're not enough idealists in the world to change the climate. We need the capitalists, and I think that's what we've managed in Norway. It's a mix of us being idealists and capitalists, and that's how we're going to move forward. And I think we're kind of starting to realize that also when it comes to finance. And I think that because there's already $1 trillion renewable market and it's growing, we see it in Norway as our role to kind of push it forward and accelerate it and make it bigger at the same time as we can make money from it. But I think that as a country that has become rich by exporting fossil fuels, we have an extra responsibility to actually contribute to changing the climate in a positive way, stopping emissions. And so I think that it kind of weighs a little bit heavy on us in Norway that we've contributed to the situation that we're in today. So we also have to be a really strong contributor to kind of change it in the right way. So I think that's important. And it's quite interesting because our sovereign wealth fund, we call it oil fund, pension fund, sovereign wealth fund. Is a bit mix of word, but it is an oil fund. It's never been a political tool. It's been really important to us politically. It's supposed to give us money back to finance everything that we need in Norway. So it's never been a political tool. So that's why it's so interesting that we actually are going into renewables now, because we're not really doing it to be idealist or save the world. It's actually because we know that we can make money from it, and we need to get the same returns from investments in renewables as in oil. So we're not really doing this politically, we're not really doing it to save the world. It's just like a positive by-effect, and that's why we pushed it like maybe a little bit earlier than we would. But I think that when it comes to the Middle East, they have quite a different approach, I think, that Norway has. But we've also had really big discussions about climate change as well. I visited Masdar in Abu Dhabi, which is quite interesting to see how they're pushing forward when it comes to renewables. But I think my impression is, and this is very like my personal opinion, is that they're probably not as idealistic as Norway. It's more like a financial capitalist approach to it, but I don't think that's wrong. Like, you don't need to be a part of this whole green wave. Like, it doesn't need to be painful, it doesn't need to be hard. Like, you can make money from it, you can be motivated by making money, and I think that's fine as long as you contribute. But I think it's also changing in the Arabic countries a lot more than we're actually kind of noticing, because the oil is kind of just a big shadow. But I think it's changing there as well, maybe a little bit slower than the Scandinavian countries, but yeah, it's interesting to see.
You want to comment on this thing? Would you like, please?
Well, I think that
Yeah.
When we did the public consultation on the energy lending policy, one of the things that was really clearly said was, you cannot any longer just look at the projects. You have to look at what the client is doing and how are they planning to decarbonize. And I think that's a challenge for us because we're a very project-oriented bank. But that's the world we live in. Money is fungible. So, we cannot say, oh, there's a wind farm and ignore what the client is doing. But also, as a public bank, we actually have a duty to support the clients that are in these high emitting industries that actually have understood and want to transform what they're doing. And that is actually an important role for a public bank going forward. So I think that it's a change for us. It's a change generally. You also see that in a lot of the initiatives now for commercial banks, that they are requiring more from their clients. They are requiring more reporting, disclosure, not just on how much climate finance did you do, but what is the climate risk? Where are your stranded asset risks? How much have you got invested in high emitting sectors? So I think the whole financial system, public and private, is shifting I wouldn't say away from projects, but to look at the system with the clients and their projects and how the whole thing needs to move.
Yeah.
I would just follow on from that by saying the thing about finance is it moves much more quickly than